Welcome to our first seminar of the fall. And for those of you who are joining us on Zoom, welcome. This is the CFAM and UBS AI and Data Research Seminar. I'm very happy to introduce Daniel Wu. He's a senior quant investment strategist at Vanguard Investment Group. As some of you know, Vanguard is the producer of the most mutual funds and second in ETFs. And so it's a big name in asset management. And since whoever says asset management or works in asset management cares about what the interest rates are doing, Daniel is going to present what's the state of the art of modeling the Fed funds rate and predicting it, and we'll see that actually there's some parts that borrow from machine learning and some parts that borrow from very simple regressions, and that essentially you have to sort of speak a bit of both languages to understand this, and of course this has tremendous impact on asset management. So I'm really curious to hear how it's done, and thanks for joining us, Daniel.
Yeah, thank you, everyone. Just a quick, thank you, everyone. It's really late time, and appreciate that you guys are a lot of people here and trying to see these topics. Actually, like when I ask like what kind of topics I want to present this time, I'm working at the investment strategy group, and here we have a lot of projects, but I'm thinking this one is the most timely one. So this is the federal fund risk. Like everyone in the financial industry are really carrying is the FOMC, right? So I think a couple of days ago, Chair Paul gave another thing. Okay, this year we may give another hiking, and then they will keep the higher risk for longer. And then we see a lot of questions after that from like journalists. They're asking, oh, do you care that? Do you care that? Like, is that what are you really based on to make a decision? They all say, okay, from data, right? The data, what means data? The data in the past, the data today is data like a long time ago or so. So I think this topic is really interesting. And this is the chart I'm actually putting here as the starting, not really my deck. The reason is I want you guys to see how high right now. Right? So how the federal fund is high right now. People talking is high, but how high it is, right? So you can see is like we are saying, what we are saying is actually after the July Fed hiking to another 25 big points, we are reaching 22 years highest level. 22 years highest level, what means that? Maybe most of you just like 2 or 3 years old at that time. Like, so basically this is the highest time during your lifetime so far. And well, another question, as you mentioned before, is like why, so another question is why that is important, right? So why does it, I will try to answer because I see you are students. So I'm thinking I will try to answer from two perspectives. The one, why it's important, I will say more on economics, markets, why that's important. Another, I will say why these kind of projects are important for asset manager, okay? And for the first part is actually, okay, when the federal fund risk is high, everyone knows it's like when you buy housing, when you buy like cars, it's more expensive or whatever. But like you can thinking even more, another framework thinking is like, when the inflation is high, your money become not really that worth as before, right? So you are trying to, okay, so we try to cut the inflation. So the monetary policy says, okay, we are hiking the risk. So we're hiking the risk is basically, you see the GDP is actually, you can see is like GDP as consumption, investment, government, and the net export. Right, so that like the consumption, of course, will be destroyed a lot, right? So it's basically people get discouraged because like when you are hiking the risk, everything becomes expensive. The money becomes expensive. Investment the same. Because even the private sector or public sector, when they try to investment, it's gonna be give you the money the cost of borrowing and the cost of, we will say that is more like the cost of capital will be more expensive. So from this perspective, you can actually see is like, okay, so the two big part of your GDP is got hit a lot, also the government. And another part, you can even thinking from the next export, which basically also based on your currency. But when your interest rate is really high, if you are in another country, what you will do, you will take your money out and deposit in the US because actually you can really arbitrage interest rate because their interest rate is high. Right, so which basically will cause US dollar goes higher. And that will cause your net export change a lot. So you can see like the interest rate actually can change the GDP growth a lot. And the GDP growth, why I'm mentioning GDP growth always important to every one of you, including me, everyone. You know, equity, when we are talking for the investment, right? So we have equity and a bond. So for the equity return, we can actually to decompose the equity return to either the valuation change, dividend yield, or earnings growth. But you can see all the companies putting together, your earnings will be the part of your GDP growth. So when your GDP growth get hit hardly, then the company's earnings will be hit hardly, which really cause how the companies can save their earnings, right? Thinking on that, how the company can save their earnings is the earnings growth can be the revenue growth and the profit margin. The profit margin, what causes the profit margin, really important, labor cost, right? So that's why everyone can feel this year, past year, and in the next year, maybe the job market is pretty tight, especially for kind of a high pay quant job, right? So you can actually connect it to there. So why those stuff can impact everyone. And another thing is like, why I put this chart here, is I think here's a couple of things really interesting to mention. You can see is like even I think starting is from 05. From 05, like Fed actually hiking, but the hiking relatively say slower, and then keep high, and then the GFC global financial crisis happened. And then they cut it pretty fast, but not as fast as 2020, right? 2020 is like a line. But after this line, what happened? What happened actually is the Fed is creating cheap money. Money becomes really cheap in 2020 and 2022, which actually caused another thing. What I will mention is when people doing the investment, the equity investment, I think you guys already know is, okay, so you have value stock, growth stock, right? Small stock, large stock, momentum stock, whatever. When the money really cheap, the growth stock flies. As we see all the like big companies, and you can see it's even something even crazier is during past 3 years, what's happened is S&P 500 during, I think, past year, gave like 15%, almost 15% of return, but 75% from 7 companies. So 7 of 500 companies created 75% of return, right? So when the cheap money happens, your growth company really flies. So that's also caused another problem, right? So when you're building the portfolio, you are thinking, okay, then I do the S&P 500, I diversify my portfolio. By the end, your return is all come from the same resources, right? So this will cause a lot of problems. It's never to say, it's like when the inflation and interest rate is high, your cost of borrowing will increase a lot. And that will cause your stock and the bond and the other multi-assets correlation become high. That's also, I published another journal during 2021. And at that time, I have a really big concern about this. But at the time, it's not really a hot topic. But because I believe you guys learning the modern portfolio series, when you're building a portfolio, 3 things are the most important. Return, risk, correlation, covariance, right? When your correlation becomes high, your traditional portfolio, you need a different ways to hedging the risk. So that's actually causing, so who will be impacted the most? It's not really hedge funds. Hedge funds can always rebalance their portfolio daily, monthly, or weekly, or second. I would say 99% of the American citizens have 401k. They are goal-based investment, long-term investment, and when their portfolio risk exposure becomes higher, these kind of projects becomes really important because we try to understand how they made the decision, right? It's not really what they tell us from a high level. Okay, we want to fight inflation to 2%. But like from the inflation from 5% to 3% could be much easier than from 3 to 2%. Because we call that inflation sticky. The last mile could be much harder and you have to pay much more than before. Will they keep doing that or they will stop? Will they keep hiking or they cutting or they slow down or they, high level? We don't know. We don't know. Every time we waiting FOMC, like when you go to the job market, you will see like when the chair ball go to FOMC, everyone like Super Bowl just waiting in front of TV, see what he's talking about, right? But we want to really understand how the decision is making. So that's where these projects come from. So this is from the market perspective. Like from the asset manager perspective, I think this is also pretty interesting to discuss because as we talked, so most of the classes maybe cover on derivative or sell side quant and also some hedge fund about the quant trading and quant strategy in really shorter time period. So what I always mention is like in different institutions, even the same title, we have different goals. Like when you try to building different horizon, for example, like how you're building like half a year, 1 year, 2 years, 3 years, all the way to 10 years, even 30 years for your clients. How you can do that? So we're starting with our micro view. And based on those micro views, we actually predicting different assets return risk correlation. We predict that in different horizons. And based on that, we have around 300 different assets globally to cover whatever the clients go. But we try to building the dynamic portfolio construction to give and then we have a lot of bottom up like those funds. Right, so this is basically where this project come from. It's in the micro, but about the macro to the capital markets, how to predict the stuff. Okay, so this is the part I want to mention. And then let's go to the deck. Yeah, one thing is I want to mention is after I can directly go here. As I mentioned, is like why this thing is important. But another thing is like then how the Fed really make decisions. So if you really monitor the Bloomberg, monitor the CNBC or whatever, people always talking the Taylor rule. Right? So Taylor rule, what is Taylor rule? So I will give a quick introduction of what is Taylor rule. Taylor rule is John Taylor. I remember at that time he was at Stanford, and he tried to make a function, try to explain how Fed made decisions. Right, so the goal is the same. They just try to understand how Fed made the decision, and even using this to guide the Fed to make a decision. So that's their original goal. But you can see the function is oversimplified. Really, really simplified. This is I directly take from their paper. So what he's thinking, so what's the logic here? But I'm thinking even the Taylor rule after year 2000 is not that works actually. The why it's not working we can mention later. So after it's not working, they have different version of Taylor rule. But the high level idea is pretty similar. Okay. So what is Taylor rule? Taylor rule is thinking is like, it's pretty makes sense. Like in long term, what Fed's role? So what Fed really want to do? They try to make the price stable. They try to make GDP growth stable. Just these two rows. Easy, right? The Fed got a lot of people, a lot of researchers, just two rows. Make the price stable, which means like inflation stable. Make your GDP growth stable. And it can make your GDP can go growth, not really go down. So like that's the Fed's role. So Taylor's thinking, okay, then we just leveraging their to go to building a function. So we call that Taylor rule. I think it makes sense. So what they put is actually like the neutral rate is like the neutral rate, we always using 2%, I think. But the other part, let's see those two parts. So what is the difference in GDP rate? So that part is like, what's the current GDP is? And what is the potential GDP is, right? So if it's negative, basically means our econ growth not really strong enough to get our potential growth. Then what we should do? Lower the interest rate to make the money cheaper. Everyone working harder to make the GDP growth stronger, right? The other part is difference in inflation rate. So this is the inflation today and their target inflation. Target inflation pretty clear, 2%, as they always mention in FOMC. So how they determine the difference? So right now, right? So your inflation is really high and their targets too, so it's positive. So when it's positive, what we should do? We increase the interest rate to lower the economics to make the price stable. See how that easy, right? So when the price is high, we increase the interest rate. When the growth is low, we lower the interest rate. That's their idea. Just make the economics growth faster, make the price stable. But you know, the economics is not always that simple. We hope that's simple. You can see most of the economics paper are simple because they have a lot of assumptions. When the assumption fulfills, it's just like this, right? It's not really like. So why it's not really like? First, 0.5 not holds, right? So you guys are the financial engineer or the math major. Why 0.5? No reason. Because they feed based on historical data. When they published a journal in 1993, 0.5 makes totally sense. So they make no sense using 0.5. The other part is like, as I mentioned, the first part, difference in GDP growth, right? So your GDP growth and your potential GDP growth, who can tell me what's the US potential GDP growth should be? So hard to measure, so hard to measure. What they can really measure in this equation is difference in interest rate, inflation rate. Right? The inflation rate based on CPI can calculate easy. Target, they can say 2%, so that part is easy. GDP growth, you know the GDP growth, but you don't know what the potential GDP growth should be. So that's caused another problem. Coefficient is one problem, that's another problem. What's the third problem? Always people thinking is, okay, so when the Fed is mentioning, let's see the labor market, the unemployment rate. Why that's important? Because when the unemployment rate is pretty low, your wage actually is high. When your wage is high, everyone get more money. They want to spend more money. Inflation go high, right? So they care the labor market, but where is the labor market? I didn't see that, right? You can see like potentially they should be connected together. As I mentioned, when the inflation rate is high, then their GDP growth can be lower, and then earning growth lower, then the labor cost will be cut, and then whatever. But that's gonna be a lag there, right? So how they can really see the labor market here, I didn't see that. Another, thinking in this way. So how about like the fuel price, the commodity price? Not seeing here anything. What means that? All the commodity get one nature. Is most of the commodity not come from one region. It's different countries have different commodity. They have to really build that. Some people, they say that globalization, and right now they creating a new word called slowbalization or whatever, just making the globalization slower. But that's actually causing another problem. Like I didn't see anything in globalization stuff or deglobalization or slowbalization, whatever you say. I didn't see that. 1993, again, totally makes sense. Totally makes sense. Nowadays, not really. Another largest part is Fed really doesn't care how stock market and bond market goes. I don't think they want to say they care, right? If they care, they will be so biased. But who knows if they care or care? You know, see, we can even explain that in another way. The GDP growth is also involved in a lot of like your financial markets growth. And the company holds stocks. The people, all the retired people, 401k hold stocks. The stocks already becomes people's part of their consumption or whatever, like their economics growth, so they have to care. So why not we put it there? I didn't see that. So that's kind of like raising our questions is that this Taylor rule can really do its work nowadays after pandemic? Because we found it's not working, right? And another part, even the last and the biggest problem here, why you only care what's happening right now? You see here, no lags. It's basically what's happening right now. It's using current data to give you the current target. But how about 3 months ago, 6 months ago, a year ago? Like those trends are not important. Like how the inflation, if your current inflation level is still high, for example, like 4%. But is that come from 2% or 8%? I think that's important. So how about the historical data here? I didn't see that. So when you are using this function, try to building a prediction, as I see here, I think it's just for fun, right? Seeing here, the feed is so bad. Because we know it's not really holds. And then this calls like, okay, then we are thinking, if we can use either machine learning or whatever way, but I always mention is like, machine learning is just a tool. It's not a solution. So I always say it's like, we are not trying to using machine learning as a screwdriver to find the problems, but we have problems, we can leverage machine learning to find a solution. But what machine learning can really do here? What we are thinking is like, okay, so if we can, let me see, go here. So this here is about the model design. So of course, we leverage machine learning, but it's not a necessary thing if we don't need it. We will not really just use machine learning for machine learning, okay? But here I will give you an example. So this example is like how we using simple machine learning to fix a big problem. I would say like at school is when I at school is during my PhD study is like always overcomplicate stuff, right? So I'm thinking it's cool, it's so fancy. I'm using like neural networks and blah, blah, blah. And by the end, it's okay. So it's 100% is the overfitting model. So when I'm working at a company, the first day, actually the first week, now first day, so our quant team has a head at that time, he already retired. But he tell me is like, I actually like linear regression more than machine learning. I say, I feel so bad because I'm machine learning PhD. You should not tell this to me, right? But he said, like, let's say this way. If you have a coefficient working past 30 years, you trust it, or you using a so dynamic model working past 30 years, and you never know if it's overfitting, you predict next month. I say linear regression, and then, okay, linear regression. But here is like a way, it's like how we really using machine learning, I'm not really, generally when you're thinking directly, okay, we want to predict the federal fund rates. Should be a regression model, right? So as Taylor building a regression model, I'm actually building a classification model. Okay? I build a classification model to predict it. 2 reasons. One reason is like, do you really care what's the level it's gonna be? Or you care they will hack or cut or hold? The direction wise. In shorter term, I care direction. Okay? This is, I know they will do 25. If they do another 50, like all the models, we don't need them, right? We got fair. So here is like the way, as I mentioned, generally, another thing I think it's really worth to mention. So when we are building the machine learning model, it's really easy to turn to be a data mining model. It's automatically, give me like tons of the data, I mine the information from. But like by the end, even the result works. How can you explain that to your stakeholder? It's gonna be really hard. You just tell, okay, the model says this. But if you cannot explain the model, even when you're building an alpha model, when you cannot explain why you are winning money, when you're losing money, you also cannot explain that. Same thing here. So we try to combine with financial theory to pick our initial factors. So
so in the regression, it seems like you're predicting a continuous variable, but you just mentioned that really it's very binary, right?
Yes, so, exactly. I will show this. So the first part actually is you have to select your initial factors based on financial theory, right? So as I mentioned, we are thinking Taylor rule, high level, 2-factor, really good. But in practical, the GDP one is really hard to do. But also another part is like they are not included the commodity, they are not included labor market, they are not included the financial conditions. So why not we include them all? We include them all and see what's going on, right? And then for your question, here is the thing, how we turn time series to be a classification model. I think you already realize how we do that, right? So this is a direction-wise the way we are doing that. I just make a simple one, but actually you can using different ways to determine the bands. So let me show you. So what's the right thing? The right one, the right line is like we pick is the change of your federal fund rates. And then we put 2 lines. So the easiest way to determine these 2 lines, because it's stationary, it means 0, right? So we just adding and -2 standard deviation. And then you determine that. But why you do that? If it's higher, we actually, in the statistics, we call that like outliers. Those kind of the Fed moves, we care a lot, or we cut a lot. In the middle, we call them hold. Hold in the range, I don't care. That should be along the complete size. If it's cut a little bit or whatever in the history, it's not really significant impact anything. I don't really care. But when they cut more, I really care. So another way to determine this is you can even think in this way. You can use a moving average. You can use in whatever way to determine your bands. You can tweak the upper bands higher and the lower bands as 0. It's all independent. Why that is matter? If your fund, your portfolio will be only impact heavily when they are raising rates. Then go low, you even don't care. You don't care. You can only care as like you can label that as 0, 1, right? Or what I'm showing here, you can label as like 1, 0, -1, 3 label, 2 label, whatever, based on you. That's kind of like one solution. You can turn to the time series model into a classification model. I think, to be honest, this thing really benefits me a lot during my research. Because generally, why that thing is important? When you are working with a micro-based top-down approach, your data is really limited, I would say, right? So when you are doing high-frequency trading, second or whatever, it's fine. But when you are doing micro-driven, what you know is the GDP data is every quarter you have 1 data point. So you're thinking if you go back to 1960, you only have, I would say, like 100 or a couple hundreds data. And it's something like CPI or so, you have monthly data. But monthly data you are thinking is like go back to 1960 to now, you have 60 years, you have 700 data points, that's it. 700 data points is really dangerous for any complicated model. It's will overfitting, right? So using these, at least overfitting model is like when you're doing regression model in such a small data set, you need to care more. But when you're doing the classification model, actually, you can deal with that easier. How you deal with that? Oversampling, or undersampling, or small, or whatever way. So let me go back. And let's see this, right? So what I'm showing here is like, you can see when you're doing classification model, I will not go detail for classification. I suppose you guys know what's a classification model, right? So the classification model is we try to determine either it's 1 or 0 to be simplified, the 1 or 0. But you can see most of the time it's 0. Most of the time it's 0. But 1 is the most important to me. But when you are building a classification model, the model will fool you. It will tell for their objective function, it will tell it's all 0. as long as you predict the result is 0. So what you will need to do is deal with the sampling technique. So when I actually learning this, I was thinking here's a lot of the drawbacks actually before I talking into those sampling techniques. Okay, the sampling technique, you can see the undersampling. So the sampling technique is the high level idea is pretty simple. We try to balancing 0 and 1. We want to in your training set 0 and 1 become equally weighted. And then when you predict it, they can all go to your results. And for here, you can see it's like you can, I just make example. Like you see the original, you get the red dots are really less and the blue dots is most of the time. Oversampling, you're just building copies, right? Just building a lot of red copies and make sure it's balanced. Undersampling is some luxury we don't have. You only have 400 data. You're undersampling. By the end, you have 7 data points. Right? You can do that in Excel or using your finger. Then we cannot do that. The smooth is somewhat good, somewhat bad, case by case. Smooth is another kind of oversampling approach, but smooth other than making copy, but you can see on the chart is in the center here are some light red dots. They randomly picking 2 dots and in the center also they creating new dots. So what's the drawback of that? The drawback of let's say the good part. The good part of smooth is that you are not making copies, right? Not making copies always make your result not that biased. But the downside is like actually we're creating some points that may not should exist there as they should. So that's really case by case. Really case by case. But by the end, I will say, I want to be fully transparent here. Is like when you are building top-down micro economics variables like inflation, GDP, those kind of low frequency data, this is the class you have to experience. It's a tough class to learn, right? So you only got, because like when I'm saying the inflation or GDP growth back to 1950, 1940, whatever, even the World War II, that's a luxury US have. We are building the EM country. Brazil, China, India, the data is like maybe starting from 2001, 2003. You have to use this. You have to use this, right? And then after you balancing the data, at least then what you can do is you can using classification model to predict the probability of each category. What that turns into economics way. Yeah, this is, as mentioned, a multiple label. This is the 2 label, is that right? 101. So this one, we only care Fed moves or not move. But this one is we care it's moves in which direction, right? So you can, what I just tried to show example is like the dynamic band, I gave it a name. So you can do this band for whatever. Why it's useful? Actually using this kind of high level framework on a lot of stuff. For example, when we determine which drivers can really turn your stop bound correlation to positive, right? You can use it, you can change the red line to be stop bound correlation change. And to using your, you can test in which set of your factors can predict 0-1 efficiently. As long as they can predict 0-1 efficiently, then you can predict that, right? So you can using the ROC traditional way. But what I try to show you is here, you see here, is we are using the normal original data set. Undersampling is something we should not use, but I just put it here. And also smooth, you can see the accuracy rate on the classification. You can see the oversampling always better, right? It's because you make it balanced. But luckily, actually, I would say the federal fund risk is not hard to predict. And here is another way to using the classification. So, you know, when we predict 0, 1, -1 as a category, we always predict their individual probability other than the 0, 1, -1. But the probability actually give you more information and directly tell you which categories belongs, right? So from here you can see, we can see this is from 17 to 21. I think I will give you more updates later. But this one, you can see the probability of hold certain level is really high. But you can see, you know, this part is really interesting. From Taylor rule, it never shows. But you see from 2020 from 2020 after pandemic hits, the probability of high risk hiking, you see the blue line, it's increased a lot. That basically shows our factor too. It's reflect what they did. Because we trained the data pre-2017, and this is auto sample, right? So auto sample, we can predict what they should do when something happens. It's more dynamic. And those probabilities, we also use that. Another part I think is really important and show you is what we found pretty interesting is total future importance. And the reason I put here is you can remember a little bit of this and then go back to check YouTube on FOMC. So what they are talking, right? This is the model we base on what they did. And as a label to decompose what they care. So for here, like we using all the factors as mentioned, financial condition. We have the economics condition. We have labor market. We have global commodity. We have the financial market, everything. So we have that, but at the same time, we have the lags, like 3 months lag and the 12 months lag. I think I put 2 lags here, but actually when we're building real-time data, we have more lags, like 1 month, 3 months or so. But we try to avoid overfitting. But here you can see, even with like .6 basically means 6 months lag. 12 means 12 months lag, right? So you can see it's like CPI, of course they really care as their target, which is inflation. So they care not only what's happening right now. You see that table? They also care what's happening 6 months and 12 months. So they do care the trend. They not really just care what's going on right now, as they mentioned. Also, what do they really care? You see the treasury, they care like the GSCT, that's kind of Goldman Sachs commodity index. So they care the commodity, right? They care S&P. So you can see when we combine everything together, so they said like, okay, we focus on the inflation. Inflation, of course, the largest part, 30%, but not 100% as they want, right? Actually, what they did is 30%. What's the next one? It's actually the treasury, like S&P, which is stock market. You can see the treasury is kind of bond market and S&P is stock market, adding together 31%, similar to inflation. That's interesting. Right? So they said like we care the inflation to 2% target. But actually when you're adding all the financial markets to make decisions, sound like they care the same. And also you can see they also care commodity like 15%, labor market another 13%. I think this chart is as we expected. Not really as they mentioned, right? Like this time, FOMC, I highly recommend you follow that. As they mentioned, oh, we care the debt bubble. We care the real estate. We care whatever. But actually how to systematically know how to make a decision based on them. Like we can base on their decision to decompose that. Because we can using those factors to predict how they make a decision, then we can actually decompose all the factors to know how they made the decision. And at least this is a simulator. And we can see it's kind of like evenly distributed and they care a lot of things as they should. Okay. Oh, here is the gram boosting. I think you don't need that one. And then it's the, oh, this is auto sample. Yeah, that's another part. Is like always here is a regression model. So what we use is using the classification model to find the key factors. After we found the key factors, we throw that back to regression. Other than directly throw that to regression. Why? Sometimes we care more on direction other than the level, right? So if we can predict the direction, even we cannot predict the level, it's still useful information. So we will not directly throw them to regression. And you can see it's predicted pretty well. So what I try to introduce high level, it's not really just the federal fund risk, but actually how you can break low frequency data to low frequency time series data to be a systematic classification problem. That's pretty creative, right? So like when people see the time series model, okay, we go regression. No, you don't really need to. What's your final goal? you can really learn. If I really just want to know the direction, you can really just go to predict become a classification, and you can really customize your classification based on your business goal. So that's kind of like a framework you can use everywhere. So like that's framework you can using that to find the key drivers. You can using that stuff to connect a lot of the economics variables to your target stuff you try to predict, and using the same thing to find the best set if they can predict or not. So that's kind of like the way. And after you do that, you can really do the do the regression. And another thing pretty interesting I will show you here is, as I promised, here's something we predict on July, on this, I think late June, about late June. So this is updated. This is our current Vanguard views on the econ and the capital markets team. So what it shows, you see the second chart. The second chart, like, I think you're familiar with that, right? So the probability of cuts only can dominate the holding and the hiking after mid of next year. That's maybe a little bit different from a lot of investment banking views. So most of the people thinking, okay, so even before this FOMC, people thinking, okay, maybe they will cut like even later this year or early next year. They'll say it will not. So this actually even the prediction before Fed made a decision before July, right? So we predict this. Or we tell market, okay, so they will not really cut until mid of next year. At that time, it's pretty unique view because most of the time, like even Goldman Sachs and JP Morgan and other banks, they are pretty actively thinking they will cut. But from our model, we're thinking, oh, it may not really cut. But actually, they will not cut. It's actually, this model pretty follows how Fed is thinking. And you can see this paper we published at June 7th, right? So in June 7th, we are thinking, okay, so they will only cut in mid next year. And I think this time on the September, they basically confirmed our views. They confirmed our views. They are thinking this year they maybe even get another hiking. And then they will, you see here, so basically by the end of the year, we are thinking the hiking line actually pretty high. And we are thinking they will get more probability of hike, and then they will hike. And then we're thinking by the mid of and to the end of next year, they will start cut to pretty confirm this stuff. So I would just say that's pretty useful. It's a small use case, but need a lot of creative. You see, and another part is the model is not really difficult, right? It's really simple. It's just what I use is random forest, grand boosting, whatever, just sample the classification model. So I'm not really deep into the model. But I think the most valuable part is the model design. The model design can using the small model to finish a really complicated goal. So that's the key part. It's not really building a neural network here, no reason. You can limit the data, but you want to finish a goal. Everyone try to finish. I just try to show a case. I think I will stop here. So any question?
Okay, well, thank you very much. Maybe, yeah, this one works. I'll ask one or two questions, but maybe people in the audience or people online can submit some questions or start thinking about it. Yeah, my first question is, so you had a very basic Taylor model that depended on two variables, and then you told us how actually there's 4 or 5 other factors that subliminally has to be in there. And I wonder if you have any NLP analysis of these meeting minutes and whether these keywords that you're talking about are being mentioned during these meetings, or they're sort of quiet and not talked about.
Of course.
Yeah. So
this is okay. Actually, a really good question for the NLP and other stuff. So what I try to show here is, let me put it here. That's going to be another really good topic to talk here. So see here, actually, we base on most on the micro factor or market factors, right? So the NLP, as you mentioned, like the minutes, of course, that's one, but you can even find something we built before called the Beige Book. So if you know the Beige Book is a survey based on Fed. So if you search Beige Book, it's a survey based on each regional bank, Fed bank, and they do some survey for each different sectors before FOMC. And those are just pure words, right? So what we built before is we scraped the data, and we found some key changes through time, and using that to build some leading indicator. But by the end, maybe I'm biased. I'm thinking is like you can really put here another thing as alternative data set. We call that alternative data set. It's maybe useful, maybe not, but you know the key problem of only using NLP as your input is that stuff unstable. You have a big assumption. The assumption is we base on their word change, and we are thinking some keywords change. But if they change their format, but if they change like the way they do it, if that stuff will take a lot of feature importance from some really solid data set, then that maybe cause some model risk. But I think that's really good. It's not really just NLP for the question. It's even for other data, you can use another couple columns as your alternative data set. But for, and another is for relatively lower frequency data, NLP may not that useful, but still, like I know a couple of people before in one of the fund, I forget which fund, they actually using Beige Book to building the GDP growth indicator using that stuff. And it looks good, but I don't know how their model really built. But at least their pitch is not really bad. So it's like if you build that correctly, I think it's still useful.
Thanks. Do we have a question from the audience here? Yeah.
Like for example, some data points like S&P 500 or Treasury yield difference, they are available on daily basis, right? So have you considered like maybe taking GDP and backfilling them to like a daily basis and then creating like a daily thing and rolling up later?
That's also a really good question about they call the mixed frequency data problem, right? So S&P they have daily, they even have minutes or whatever. These are the most frequent, flexible data you can have. So most of the time, we actually convert that to return, right? To like quarterly return and then match to GDP. I would say I can tell you why. Actually, when you are building a model, it's really based on how business needs. If they need the monthly, and you still need the GDP data, you can only update the other stuff, not really, only other stuff already updated like CPI or whatever, but GDP you have to keep as constant. For linear model, it could be okay. That's also another part of what I say why I like linear model because it's relatively robust. When you are using machine learning model, you have to remember one thing is like the relationship you build is based on the movements of the data set, not only three of them. Right. So actually what it catches is like all your factor together. But if three of them not moving, three of them moving, actually you creating a logic actually misleading the model. And the logic not holds. I tried, it not holds.
One more question about like in the classification, okay, we are able to predict whether it's going to go up or down, but how do we capture like extreme movements? Like sometimes we care more about the extreme rises, like yes.
So that's also a really good question. So when let me tell you how this idea comes from. It's pretty weird. It comes from when I was starting my work as a trading desk, like fixed income treasury. You know one thing called Bollinger Bands, right? Similar, right?
Yeah.
Yeah, that's actually where it's come from. So in the kind of like the bands, you can build in 4 bands. This is a 2 bands for the stage 1 movements, adding another 2 bands for extreme bands. So you have the label for label on label. So for example, you predict become like 1, 2, 3, 4, 5, and then you predict the extreme one.
But there's no training data on like those kind of points, so it wouldn't be able to predict that.
For sure, that's actually for every single forecasting model. One stuff you will have to face is something never happened. If it's never happened, what I really hope is the model cannot predict it. It's fair. if it's never happened and you can predict it, your model go crazy, right? So like if you go back, if you check one really famous model to predict the equity return, it's called it's Yale University called Shiller's Cape model. You know that? It's like the EP earning EP model, like earnings price model, but they average the earnings with 10 years. So they predict 10 years return. For that one, actually, you can predict the 08, 07, 08 because into year 2000 dot-com bubble valuation is so high, so it will converge. But you can never really predict year 2000, but it's fire. But if you can predict, it's a problem. Also, I never think the model should be able to predict this easy if you don't have real-time data, right? Because that's the part that you have to understand is they say all models are wrong, some are useful, right? So why it's useful is give you the guidance. That's why I'm saying is the direction sometimes is more important than level. Because if you can predict, it will go high. But you never know how high it is, right? So I know here will go high. You see my screen? You go high. But even you know it will go high here or here. You're not predicting, right? But you know it will go high. Actually, you already have a layer of risk management on your portfolio. So that's why I'm saying the regression model, you will miss this key part. It's a direction-wise prediction other than the level-wise. The level is really hard to predict, but direction kind of like much easier to give you the direct answer.
So we have an online question, which is about backtesting. So have you backtested your model? Are there, how did you do it? Or how would you think about backtesting?
Sure. So for this kind of model, of course, with backtesting, all the model need backtesting. The backtesting is pretty interesting part. So yeah, I will mention two parts are pretty interesting on the backtesting when you do time series. I will say it's pretty benefits from experience. One is extending window versus rolling window, right? Extending window versus rolling window. When you have a lot of data, rolling window always the best, no doubt. But when you have limited data, you will say, oh, you waste one data point, you like lose $100, and you just feel hurt, right? So but those data actually can kill you. The fundamental relation changed. So when we are building these, actually you have to find is like why we building those stuff. Oh, another part. You know, here is like we design the bands. You can even using clustering to cluster 3 bands. That's another way to. That's going to be more dynamic because when you're choosing rolling window, when you're using clustering, it's give you a more dynamic bands within that window, right? So that's one part. Another part, as I'm thinking is, as you mentioned, when you're doing the time series backtesting, right? Time series backtesting, before we always just, okay, we train the model and then we predict the next 2 or 3 steps. But actually, right now I'm thinking the safest way is actually they call embargo or whatever, I forgot the name, but you take both the training and the test 5% out, the connected part. 95% of training to predict the testing, but testing always also take the 5% out. So total 10% out in the middle to make sure there's no bias.
And actually this is, I wanted to ask another question about, you talked a lot about classifying whether the rates would go up or stay the same or go down. Have you, and then you showed several steps ahead. So is that, you know, how does your model take into account the idea that GDP will go up and inflation will go down and all these other variables? How do they, is there a dynamic model for all these things?
Exactly. So for this model, it's pretty dynamic. This is unfortunately not a linear regression model, but actually we have more dynamic feature importance on this. What we really deliver, as I mentioned, we will not really deliver hiking, pausing, or stop, or cut. We will deliver the probability. You see the probability here. So we predict the 3 labels, but each label will have the probability, and those probability actually give us more confidence, right? When you are using either random forest or either whatever classification way, it's actually just putting like 0.5, like 3 is 0.33. Like using their threshold, if you higher than that, then they tell you it's cutting. But actually, their probability can be really, really close, right? So that's what the model can give us. At least from here, we can see what we can give a conclusion. And that's the conclusion we gave is like Fed will keep higher and longer, right? So that's from here, it will keep higher and longer because you see the probability of hiking and the probability of pausing, they're relatively higher than cutting. That's kind of like the information we want to give, other than we tell you next year 3%. I even don't trust myself on that. Right? But we give the probability. Go ahead.
For this model, or just like any other similar kind of model that are based on fundamentally based on like a linear assumption, how do you handle the interaction between the features? Or like if does that really concept, right?
You mean you want building a linear regression model?
Or like I guess in this one, not exactly regression, but in cases where I don't know, like if you have like if two variables are not entirely independent from each other, like do you kind of like take that into account, or do you just still kind of just
Correlated features.
Right, yeah.
Like correlated features.
Is it a problem if the features might have a correlation structure? Do you take it into account, or is it not?
That's a really good question. You know, it's like that's kind of like we call the feature pre-processing, right? So when actually the features we choose here is fine, but the lags are correlated, right? So that's why we are saying why we are not using, we're using 6 months lag, 12 months lag, why we are not using 1 week lag, 2 weeks lag, because that's useless and it's cost your whole dimension too high, and it's really cost a problem. Yeah.
So when like the model is trained, it will be obviously biased towards the lagged variables, right? So how do you balance that?
You can determine the weights. So for example, like when you are doing this, we are still getting assumptions that newest data give you more value. So we are thinking, okay, in the history, we can give a penalty. So when you give it a penalty, then its weights automatically will be lower a little bit. Basically, we determine like somewhat like grand descent feeling. It's like go this way. So if you go, it's somewhat, I would say, we build a function, but it's somewhat like a long short-term memory. You remember that? So long short-term memory, that's the neural network. You can give a forget gate, right? So you can determine how long history you want to forget and how much weight you want to give it based on the states. So yeah, that's a really good question. We don't want the lags dominance everything. But if after we gave it a penalty, it's still higher than current data, it shows a lot.
Building off that, I mean, you mentioned that the U.S. is unique in that there's data going back to the 40s based on Fed decisions. But is data from the 40s and 50s even really useful for your training? Because the way the Fed operates is very different from back then.
For this model, no.
Okay.
Of course, no. But I give you an example when it's useful. When you are trying to using value converge based equity return forecasting, still useful. Right? So even get longer history, but you believe like the valuation, when valuation is high, the return should be go down. When the valuation go low, it should be go up. So those kind of relations should really hold long term. But if you really, so when you try to building a relation, long term helps. When you're trying to build a really dynamic relation, long term now helps. Oh, go ahead.
Have you like tried maybe like feature engineering for some kind of variables, and maybe what kind of success you faced during feature engineering?
Oh, of course. Actually, I don't have my paper here, but you know, we are pretty crazy. At first, we had 70 something, 80 different vectors. It's too many. And actually, as I mentioned, why we're building this model, another reason we're building this is like we build a extremely complicated loop to loop all the combinations of your vectors. And then we try to see which combination can predict this vector. And those combinations are the most useful for time period you choose. Why we're building the combination is because I found another paper said like even single factor are independently have the most predictive power, but when you combine it with other variables, it may not be the best one. So you always, when you're building a classification model, you always do find the best combination, not every single one. So that's pretty time consuming actually. But for this one, actually pretty lucky. That's why I'm saying, when you are purely doing data mining, that's headache. But when you have to follow some financial and economic theory, then I know they care inflation, right? But I don't know how long the inflation they care. They care 1 year, monthly, quarterly, 10 years trailing, 2 year trailing, I don't know. So I need to figure it out. But at least I can narrow my selection to be a relatively small data set.
So was it like a pairwise polynomial feature engineering thing?
Yeah. Go ahead.
Why wouldn't you use why couldn't you consider using a neural network instead for a multi-classification problem when you wanted to just...
Data too small. Data too small. That's just one answer. I want to use it. Okay. But we will have 100 data.
Okay.
We have an online question that is a bit complicated, but I'll try to paraphrase it. I think it has to do with have you used as a factor the time since the last move? So for example, we saw that for long times, the rates were flat. And then if it starts going up, then it's quite much easier, I suppose, to predict the next one will go up. So are there some very technical inputs that you've used?
That's actually, it's not really included here, but included in my another model. We call that, so that's called the financial turbulence. Anyway, so in that model, it's not really just the level of your inputs, also your first derivative, right? So your first derivative of because you know, sometimes the model we build is not really straightforward as it is. This is just easy to present. The sum of the model, your inputs even from other model. And those results are also a probability, right? So for example, using this as input for your another asset pricing model. This as 3 columns, right? This as your other model inputs. So for this model, other than using this number directly, from here to here, the change of this line, the trend, actually another big information. You can use it.
Okay. Any other questions from the audience here? Okay, well, let's thank our speaker. Thank you.